Wouldn't you love to get the tiniest advantage in the option world? And have you ever wondered how the option price can update so quickly and accurately when the underlying stock move? Introducing the Greeks. Let's dive in. And no, it's not AI. I know. Everybody starts throwing the word AI on every program and services they are offered. But the Greeks has been around since 1973. They are a set of risk measures named after the Greek letter that donate them, which indicate how sensitive an option is to time value decay, change in implied volatility, and movement in the price of the underlying security. Learning about the option Greek is crucial for option traders because it provides you with the valuable insight into the behavior and characteristic of the option contracts. Delta. Delta is one of the most important and most used among option Greeks. It measures how much an option price is expected to move for every $1 in the price of the underlying asset. Imagine you have an option that has a delta of zero point 0.5. This means for every $1 increase of the underlying asset, the option price is expected to increase by 50 cents per share or $50 per contract. Remember, each option control 100 shares. Similarly, if the price of the underlying decreased by $1, the option price would be expected to decrease by $50. Delta can be positive or negative depending on whether the option is a call or a put. For the call option, delta range from 0 to 1, where delta of 0 means the option is out of the money and unlikely to move with change in the underlying asset price, while the delta of 1 meaning the option is deep in the money and move almost point to point with the underlying asset. For put option, delta range from -1 to 0, where a delta of -1 mean the option is deep in the money and move almost point for point with the underlying asset in the opposite direction, while a delta of 0 mean the option is out of the money and unlikely to move with the change in the underlying asset price. In summary, delta tell us how sensitive an option price is to changes in the price of the underlying asset. It's a crucial concept for understanding how option price move and for managing risk in option trading. Delta can also be used to represent the percentage that that option will end up in the money. So an option with a delta of 20 mean there's a 20% chance that that option will at some point be in the money. So if we look at my account and let's go, for example, to Microsoft options. Here I have selected the 5 months, the October 18. And if we go on the call or put, in this case, let's start with a call. On the desktop version, Robinhood allow you to change two metric to anything that you want. So in this case, I think by default it's break even, but you can change it to anything from implied volatility to the bid or ask price, volume, open interest, and you can scroll down to see everything including the Greeks, delta, gamma, theta, vega, and rho. So if we went and change it into delta, which I already did, you will see the different delta for each strike price. Here for 420, you see the delta is 0.58 and is changing with the live change in the underlying price. The deeper you go into the money, the higher the delta will become, which means the closer the option price will move relative to the underlying stock because it has a higher chance of expiring in the money. Gamma. Gamma is closely related to delta. While delta measures the rate of change in an option price for a $1 change in the price of the underlying asset, gamma measures the rate of change in delta for the same $1 change. Here is a simple way to understand gamma. Imagine you have an option with a delta of 0.5 and a gamma of 0.05. This means that if the price of the underlying asset were to increase by $1, causing the option delta to increase from 0.5 to 0.55, then gamma tell us how much the delta change. So with a gamma of 0.05 for every $1 increase in the price of the underlying asset, the option delta would increase by 0.05. If the underlying asset price were to decrease instead, the delta will decrease and gamma would tell us how much delta change in response to that decrease. So let's take a live example. If we went to Microsoft and scroll down, I have a call that I sold. It's a cover call for 420. Right now it's at the money, so I'm doing good so far on this. If we went and scroll down to see the status, you will see currently the delta sit at 0.52. The gamma would indicate how much is that change for every dollar that the stock is going up or down. As you can see, it's 0.0199 and it was 0.02 just a few seconds ago, meaning it will change, let's say, by 2 cents for every dollar that Microsoft will go up and down. That 2 cents is a change in delta, which affect the very next dollar that the price will move. Theta. Theta is a crucial concept in option trading. It represents the rate of time decay in the option price as it approaches expiration. Here is a simple example of explanation. Imagine you have an option of theta of a negative 0.03. This means for every day that passes, all else being equal, the option price is expected to decrease by $3. Theta is often negative for both calls and option because options lose value over time due to the diminishing time until expiration. As an option gets closer to its expiration date, its time value decreases, leading to a decline in its price. Let's take a quick live example on the same option that we are using here, the Microsoft, the 420 call. Right now, the price is at 419 and it's moving ever so slightly. If we scroll down again to see the Greeks, you can see theta is set at 0.21, meaning within today, the option price will decrease by $21. That decrease happened during the day, so it doesn't happen at the open or the close. It happens slowly over the entire day. Vega. Vega can be your best friend or your worst enemies. Vega is a measure of an option sensitivity to change in implied volatility, which is the market expectation of how much an underlying asset price will fluctuate in the future. Imagine you have an option with a vega of 0.03. This means if the implied volatility were to increase by 1 percentage point, for example from 20 to 21, the option price would increase by 0.03, meaning 3 cents per share or $3 per contract, all else being equal. Similarly, if implied volatility were to decrease by 1 percentage point, the option price would decrease by $3. Vega is positive for both calls and put options because higher volatility generally leads to higher option prices. This is because higher volatility increases the likelihood of an option reaching its strike price and thus increase its potential profitability. Conversely, if volatility decreases, option prices tend to decrease as well, leading to negative impact on vega. Options with longer time to expiration typically have higher vega because they have more time for potential volatility fluctuation to affect their prices. Traders pay attention to vega, especially when constructing option strategy that involve assumption. For example, trader might buy an option when they expect volatility to increase, positive vega, and sell option when they expect volatility to decrease, negative vega. Understanding vega help option traders assess the impact of change in implied volatility on their option position and make informed decision about when to enter, exit, or adjust their trade based on their volatility outlook. Let's take a look at the live example we have here. As you can see here, the implied volatility is 19.48. Vega is negative 0.41, meaning for every point that it goes up or down, the vega will affect our contract by $41. More implied volatility mean bigger expectation in the fluctuation of the price, meaning it can go up higher or it can go lower higher. This change will create a higher premium coming directly from the vega. That's why a lot of our strategies will target option with a higher implied volatility to make use of this vega to generate a higher premium that can benefit us as the seller of these options. Raw measures the sensitivity of an option price to change in interest rate. As you know, interest rate does not change on a daily basis. It's controlled by the federal government and only change ever so slightly every year. In a future video, I will dig deep to every single one of the Greeks and provide more detailed video. I will also follow up with a new video soon talking about my most recent option changes, and we will discuss the option delta and how it affected my option in a positive or negative way. In a future video, I will discuss how to look at an option premium and divide it into intrinsic value versus extrinsic value, And we will also explain my favorite method, which is using theta in Vega to generate income from the extrinsic value part of the option. If you find this video helpful, please consider giving it a thumbs up and leave a comment discussing your experience with the option Greeks and how you used it. As always, the information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, including the potential loss of principal. Thank you guys. See you in the next video.